In this section, we're going to cover preferred stock bailouts. Preferred stock bailouts used to be a way to get money out of the corporation and not take it as a dividend. So we wanted to take it as some other way that would give us capital gain treatment or something like that, so we didn't have to pay more tax on it. So this is how we would have accomplished that. First, a corporation would issue a non-taxable stock dividend of non-voting preferred shares to its common stockholders. Under the rules relating to non-taxable stock dividends, a portion of the common stock basis would be then allocated to the preferred stock basis, and its holding period would include the holding period for the common stock. Next, the shareholder would sell some of that preferred stock at its fair market value to an unrelated third party. So when they sold it, the shareholder would have gain, but the gain would only be the sales price minus its basis. So the gain would be smaller than a full dividend. And then the corporation would redeem that preferred stock from that third party, usually at a premium. Or instead of step 3, the corporation would redeem the preferred stock directly from the shareholder. But either way, the shareholder was able to get money out of the corporation and pay capital gains rates and also pay it on a smaller dollar amount. Of course, Congress did not like this, so they enacted Section 306 to combat it. Section 306 stock is stock that's received as a non-taxable stock dividend, stock received in a tax-free corporate reorganization or corporate division if the effect of the transaction was substantially the same as the receipt of a stock dividend, stock which has a basis determined by reference to the basis of Section 306 stock, and stock acquired in an exchange to which Section 351 applies if the receipt of money would have been treated as a dividend. If we have Section 306 stock, this section is going to change the tax result of how we get rid of it. So if we dispose of it, that means by sell, right, to someone, to not the corporation. If a shareholder sells or otherwise disposes of Section 306 stock, the amount realized is treated as ordinary income, so not capital gain, to the extent it would have been treated as a dividend at the time of the distribution if money had been distributed rather than stock. And so at the time of the distribution, it would have been treated as a dividend to the extent of earnings and profits. All right, next, redemptions of 306 stock. So if instead of selling it, the corporation redeems it. If Section 306 stock is redeemed by the issuing corporation, the amount realized is a dividend to the extent of earnings and profits in the year of redemption now. So now it's the year of redemption, not the year of issuance. Any amount received in excess of earnings and profits is first a recovery of basis and then gain from sale or exchange of stock. And then there's some exceptions. Section 306 does not apply if a shareholder sells all of his or her common and preferred stock in a corporation, thus completely terminating his or her interest, or the corporation redeems all the shareholders' common and preferred stock, completely terminating the shareholders' interest. So if you're selling off everything, this tax treatment doesn't apply. Fran owns all 100 shares of Star Corporation stock. Her stock basis is $60,000. On December 1st of the current year, Star distributes 50 shares of preferred stock to Fran in a non-taxable distribution. In the year of distribution, Star's total earnings and profits is $100,000. The preferred shares are worth $150,000 and the common shares are worth $300,000. So this is Section 306 stock, right? It's preferred shares in a non-taxable distribution. A, what are the tax consequences to Fran and to Star if Fran sells her preferred stock to Ken for $200,000 on January 10th of the following year? And that year, Star's current earnings and profits is $75,000, in addition to the $100,000 balance from the prior year. Okay, so first we need to figure out the basis of the preferred and common shares. And we're going to allocate based on the relative fair market values rather than just the number of shares because they're a different class of shares. So it told us the fair market value of the preferred and the common shares. And so this is how we would do that based on relative fair market values. $60,000 is her basis in the common stock. So after reallocation, her preferred stock has a $20,000 basis and her common stock has a $40,000 basis. And she's selling the stock for $200,000. All right, so remember Section 306 is going to tell us we treat that as ordinary income to the extent it was a dividend in the year she received it. So in the year she received it, the corporation had $100,000 of earnings and profits. So it would be a $100,000 deemed dividend. All right, and then remember when we treat something as a dividend, after we run out of earnings and profits, we do return of capital. And so the capital, the basis she has allocated to her preferred shares is $20,000. So there'd be a $20,000 return of capital. So now we've taken care of $120,000 of the $200,000 she sold her stock for. The remaining $80,000 is a capital gain. And Star Corporation makes no adjustment to its earnings and profits. All right, so that was a disposition, excuse me. Part B, how would your answers to Part A change if Fran sells her preferred stock to Ken for $110,000 instead of $200,000? All right, so then we would still be a $100,000 deemed dividend, and then only a $10,000 return of capital. So she still has a $10,000 basis in her preferred shares. Now Part C, how would your answer to Part A change if Star redeems Fran's preferred stock for $200,000 on January 10th of the following year? So now it is a redemption of preferred stock. All right, so now we treat it as a dividend to the extent of earnings and profits in the year of redemption. So let's look back at the problem. So in the year of redemption, it tells us, in Part A, it tells us in that year, the January 10th of the following year, in that year, Star's current earnings and profits is $75,000 in addition to the $100,000 balance from the prior year. So now we have $175,000 of earnings and profits. So we have a $175,000 dividend to Fran, a $20,000 return of capital, and a $5,000 capital gain. She has a $20,000 basis in her preferred shares. Remember, we calculated that in Part A, so that's recovered tax-free. The $5,000 is a capital gain. The $175,000 is ordinary income. Star's earnings and profits is going to be reduced by the whole $175,000. If we have redemptions by related corporations, Section 304 is going to require sales of shares from one related corporation to another to be treated as stock redemptions. And the same redemption tests discussed previously are going to apply to determine whether it's sale treatment or dividend treatment. So we've talked about in a previous chapter, brother, sister, and parent sub corporations. That's what we're talking about when we say related corporations. So a redemption by a brother-sister corporation, if a controlling shareholder sells stock of one corporation to the other corporation in exchange for property, the exchange is recast as a redemption. If the redemption does not qualify as a sale, it's treated as a dividend, made first by the acquiring corporation to the extent of its earnings and profits, and then by the issuing corporation to the extent of its earnings and profits. The shareholder's basis in the issuing corporation's stock that was sold is added to his or her basis for the acquiring corporation's stock. The acquiring corporation takes the same basis in the issuing corporation's shares that the shareholder had. If the redemption qualifies as a sale, the shareholder's recognized gain or loss is the difference between the amount received from the acquiring corporation and the shareholder's basis in the surrendered shares. In a parent sub redemption, if a shareholder sells stock in a parent corporation to a subsidiary of the parent, the exchange is treated as a distribution and redemption of part or all of the shareholder's stock in the parent corporation. If the redemption does not qualify as a sale, the distribution is treated as a dividend from the subsidiary corporation to the extent of its earnings and profits, and then from the parent to the extent of its earnings and profits. As in Section 306, dividend treatment results in the gain being taxed at a maximum rate of 15%. The shareholder's basis in his or her remaining parent corporation stock is increased by his or her basis in the stock transferred to the subsidiary. All right, and this graphic is in your book. It is just a summary of what we've been talking about. So generally, our general rule, a distribution and redemption of stock is treated as a dividend. There are exceptions that qualify for a sale, and we went through those 5 tests. And then there's special redemption rules if we have preferred stock bailout, Section 306, and then controlled corporations. So transfer of stock, sale of stock between controlled corporations.